All right, ladies and gentlemen, it is 3:30 Chicago time on Wednesday, and that means it is time for another episode of the OIC's webinar series. Welcome. I hope those of you that are joining today were able to catch last week's presentation, the first session of premium income. This is our summer of selling, as we're calling it. All of the sessions that we're going to be presenting throughout June, July, and August are going to involve selling options for what we call premium income. Last week's session, the first session of June, was covered calls, one of the more popular strategies out there that investors use to squeeze a few extra dollars or shekels, as my old boss used to say, out of the shares that they already own. And today we're going to be talking about the other side of that coin, cash secured puts, and then we're going to somewhat put those two strategies together in what we call the wheel strategy. For those of you just tuning in, welcome. My name is Mark Benzaquin. I am a principal here at OCC and part of the investor education team. Speaking of the investor education team, I'm very fortunate to have two of my colleagues, Ken Keating and Matt Cashman, behind the scenes to answer any of your questions that come in. So underneath that media window, you'll see a Q&A box where you can go ahead and submit your questions, and Matt and Ken will go ahead and address those live throughout the presentation. And then at the end of today's session, I'll take some of those questions that they set aside to me, and we'll address it to the larger audience. So let's go ahead and get started. We've got a lot of material to cover. Our standard disclaimer to satisfy our attorneys. Basically, it says options involve risks and are not suitable for everyone. As a matter of fact, those risks are outlined in a document called the Characteristics and Risks of Standardized Options. You can visit our website, optionseducation.org, and download an electronic copy. And if you're looking for a hard copy or a physical copy, you can go ahead and reach out to one of the exchanges or your brokerage or trading firm. The scenarios that we're going to be talking today, the examples that we're going to be using, we're simplifying everything, so we're not going to be including real-world costs such as commissions, fees, margin, taxes, etc. And the examples that we are using are simply for illustrative purposes. We are not endorsing, recommending, or soliciting for you to trade any particular strategy or trade at all for that matter. Trademarks that you're going to see throughout today's presentation, those belonging to OCC and OIC, the Options Industry Council. And speaking of the Options Industry Council, if you're not familiar with us, if this is your first time joining us, again, welcome. The Options Industry Council, or OIC, we are a free resource provided to investors throughout the industry. We offer unbiased and professional education. The reason we say unbiased is because we're fairly agnostic. We don't care what you trade. We don't care how you trade. We don't care what security you use or what strategy you trade, etc. What we want is for you to have a clear understanding of how trading options work, again, what those potential risks and rewards might be, and that's where our education comes into play. We are not financial advisors, so we don't make recommendations, we don't provide advice, and also because of that, you'll see there are not real-world examples that we have in our presentation. We often get questions of why don't you use a case study on a specific stock, and the reason being is we don't want to be seen as endorsing or recommending any one particular security over another. The majority of our efforts are concentrated on our website, optionseducation.org, where we have a wealth of information in the form of online courses, podcast videos, and webinars. And then again, the pride and joy of OIC, that is our investor education team. You can reach out to us via email at options@theocc.com, or you can live chat with us on our website. And then again, just to remind everybody, we've got Matt and Ken behind the scenes answering your questions, so please go ahead and send them in, and we will get those answered to you just as quickly as we can. So as I mentioned, we're going to be talking about the flip side of the coin when it comes to covered calls, and that is going to be cash secured puts. We're going to talk about what a cash secured put is, why investors might use them. We're also going to talk about, just like last week with our covered call presentation, we're going to get into strike selection. We're going to get into various scenarios of what might happen at expiration. And then we are going to, as I mentioned, talk about that wheel strategy, which is somewhat of a combination, if you will, of covered calls and cash secured puts. Very, very popular process that investors use to continually sell options and generate additional returns and premium income when doing so. And then we will close everything out with some Q&A. So let's go ahead and get started with the cash secured put mechanics. A cash secured put is a short put. What a short put means, it's a put option that we sell. We are a writer. And if everybody remembers back to our Options 101 education, when we write an option, whether it's a call or a put, we are accepting an obligation. And that obligation is either to sell shares of stock. In the case of selling a call option, remember our covered call last week, we sold a call against the stock that we held. And if we got assigned on that short call, we would then go ahead and be obligated to deliver those shares or sell those shares. Cash secured put is no different. When we sell a put, we still have an obligation. And in this case, that obligation is to buy those shares of stock rather than sell. So when we sell puts, we're obligated to buy that stock if we get assigned. The price at which we are obligated to purchase those shares is the strike price. So if we get assigned on a short put, we are obligated to purchase those shares. We would see the money being debited out of our account. If it's a standard put option, we would expect to see a debit equal to 100 times the strike price. And in return, we would be credited that stock, 100 shares of that stock. For people that sell puts, they're typically neutral to moderately bullish on a security, or they have an expectation of falling implied volatility. It's funny, myself and my colleagues, we spent decades on the trading floor, and I remember there was an individual whose license plate on his Porsche was sell puts. So selling puts is a strategy that investors certainly turn to if in moderately bullish markets. The reason being is that if that option expires out of the money and without value, then the put writer retains 100% of that premium that they collected at trade inception. And it can be a strategy, certainly if you've got a moderately increasing or moderately upward mobility market, it might be a strategy that investors turn to generate those income returns time and time again. But like any written option, right, there's always going to be risk. So when we sell a put, we've got little, if any, downside protection. Remember, when we are assigned on a short put and we're obligated to buy that stock now becomes our risk. So regardless of how low share prices fall, our obligation remains. If we sell, for example, a $100 strike put and shares fall down to $50, we can expect assignment at expiration, and we are now the proud owners of 100 shares of stock at $100 per share when the stock is trading $50 in the marketplace. So we've got little protection to the downside other than the premium that we received when we sold that option. Again, similar to the covered call. But that's really the only protection that we have, because we can be assigned regardless of how low those share prices fall. There's a phrase that you may have heard called buy the dip. And what that means is if an investor foresees or forecasts a temporary downturn in the market, a temporary reduction in share price, but they feel those share prices might rebound at some point, that would be called the dip. So an investor selling short puts, they may try to buy the dip by selling that put option. Really what they're looking to do is buy those shares at a discount, so lower than the current price that it's currently trading, or, as you can see, the second point here, generating premium income. Because again, anytime we're selling options, that's typically one of the main goals that we have, is collecting that premium income. So a cash secured put, it's a combination of that short put with an appropriate amount of cash to cover that assignment. So again, we are obligated to purchase those shares at our strike price if we get assigned. So our trading firm is going to want to make sure that we've got enough cash in our account to cover that potential assignment. So the reason it's called cash secured is that very reason. Our assignment obligation is collateralized or covered by having that cash already in the bank. So we want to make sure when we sell that put, or I should say our trading firm certainly is going to want to make sure that we've got enough cash in the bank to cover that potential assignment. Generally moderately bullish or even short-term bearish is our expectation. Again, moderately bullish, the reason I say that is because if we were aggressively bullish on this stock, let's say XYZ, again, similar to last week's covered call, if we're aggressively bullish, well, we're going to be leaving a lot of money on the table. Because with the case of a cash secured put, if stock prices keep going up, we're never going to receive that assignment. If we sold a $100 strike put and shares are trading 102, 104, 110, 108, what have you, our put is never going to be assigned, and all we have is the premium that we collected when we sold that option. However, you could also be short-term bearish. Again, that buy the dip. Maybe we've got an earnings announcement coming up. Maybe there is a Fed announcement, interest rates, something that might cause a temporary downturn in the price of that stock. So we're short-term bearish, but maybe we've got a long-term bullish outlook. There's a saying that we have, or that we used to have on the trading floor: if we like it at 100, we've got to love it at 95. So that's kind of the situation here. Maybe stock's trading 100. We think it might temporarily pull back. We would love to get into those shares at that pullback price, right, at a discount, before things reverse and the stock starts going up again. So potentially short-term bearish, moderately bullish over the long run, expecting those share prices to rebound at some point. But again, our primary goal is we want to buy those shares at a discount. We want to buy them below where the share prices are trading, and generate premium income in the interim. One of my colleagues refers to a cash secured put as basically being paid rent to wait for the opportunity to own that stock. And it's something that I like, because you do collect that premium up front in the hopes that shares pull back a little bit before you become that shareholder. It also reduces our break-even point. Again, if stock's trading 100 and we were to sell, for example, a $95 put for $3, our break-even point would be $92. So as long as shares finish above $92, we're going to make money on this trade. Had we just purchased the stock outright for $100, any reduction in share price below $100, that's going to cause us to lose money. So with the cash secured put, it helps us reduce that break-even point. But again, just like that covered call from last week, our primary risk remains with that long stock. If we get assigned on this cash secure put, on our short put, we've got risk from whatever our strike price is minus the premium that we collected. Remember, that's going to be our break-even point, and we'll get into that when we look at an example in just a moment. But once we're in that stock, once we own those shares, we've got risk pretty much all the way down from that price point all the way down to zero, or as near zero as a company can get without being bankrupt. But again, that's going to be our primary risk. If we get assigned and we're saddled with shares of stock, that could be a problem. Again, selling cash secure puts, people may do it on a weekly basis, monthly basis. They may incorporate this into their daily or usual trading repertoire, their arsenal of strategies. They can trade them at any strike price they want, because that strike price is going to be the price at which we are, in a sense, buying in to that stock. So do we want to buy in the stock at $90? Do we want to buy in at $95? Do we want to buy in at $100? That is going to be determined by our strike price. And then obviously, like pretty much any other strategy, we can also tailor our days to expiration. Some people might choose a shorter time frame. Some people might choose a longer, something we'll get into in a little bit. As we remember, time is money, so the further we go out in terms of an expiration date, the more premium we as a seller would collect. But obviously, with more reward comes more risk, and vice versa. So, we have no idea where that stock is going to go over the next 2 months versus 2 years, or even 2 days for that matter. So just like pretty much any other security, or I should say any other strategy, our strike price, that is going to determine where we buy in, and our days to expiration can be tailored as well. If we're trading American-style options, that's going to be our equities. So our stock, that's going to be our ETFs. Those are all American-style options. And that means that we can be assigned at any time. Now, unlike last week's covered call, where early assignment can happen in periods of, for example, a dividend being paid, it's unlikely, but not unheard of, but it's unlikely that short puts get assigned early. And typically that would happen maybe in a period of very high interest rates, right? Because if we get assigned, we're paying cash to the put holder, and when they sell the stock to us, we're paying them cash. If they can generate a larger return with our cash and some other investment, maybe they would exercise that put early. If the put is deep in the money and there's very little time value left, that might be another reason that our short put would get assigned early. But barring those two scenarios, early put assignment isn't something that typically happens. But again, if our contract is in the money come expiration, it would almost be a guarantee that our short put would get assigned. And so that's one of the risks of short puts, right? Assignment. And we know that going in, anytime we sell options, assignment is always a possibility. But that's not necessarily the only risk when it comes to puts, right? We wanted to buy the dip, but what happens if shares don't just dip, but they plummet? Declining share prices will lead to higher put prices. Remember, puts are inversely correlated with the stock price. So as stock prices go up, the value of the put typically goes down. As stock prices go down, the value of the put typically increases. So if share prices are declining and we want to manage our position by closing out, that might be expensive, because now that put that we sold for $2, maybe now it's trading for $10. Also, if the prices are declining rapidly, that might that might fold, as you can see here, and I can't think of the word, so I apologize, but that might further exacerbate the situation because not only is the value of the put increasing due to those declining share prices, but the value is increasing exponentially more so because of the increase in implied volatility. So now we've got two things working against us when it comes to the short put. We've got the increasing price of the option due to delta, right? And that's coming from the declining share prices. And we've got increasing prices due to Vega, and that's, comes from the implied volatility. So that $3 option that we sold, now maybe it's trading for $10 or $11 or $12. So it's going to be expensive for us to get out of that position if we need to. And then lastly, remember I had mentioned that shares could, go down to near zero. In the event of bankruptcy, if the shares are canceled by the bankruptcy courts and no longer exist, then an investor selling a put would have to pay their strike price times 100, right? They would get assigned, and they would receive nothing for that assignment. So they're not receiving shares of stock because the bankruptcy courts canceled those shares, but the put holder, right, the buyer of that put still has the right to exercise. So when it comes to bankruptcies, when it comes to delisting, these are questions that we often get at the investor education desk. Even if in the event of a delisting or a bankruptcy, the rights and obligations of options buyers and sellers still exist. So in the case of bankruptcy and if the courts cancel the shares, the put seller would likely be forced to pay their strike price times 100 and receive nothing. So, you might be thinking that, well, so those are all risks if prices go down. If prices go up, then typically what would happen is that short put would not get assigned. And if you really wanted to own these shares, you may have to turn around and buy them in the open market at a price higher than where the shares were trading when the trade was first initiated. So you might miss out on that buying opportunity. It might be the one that got away, or you might be forced, although it certainly would be your choice, but you might end up paying much more for those shares than had you just bought them outright at trade inception. So again, just like any other strategy, there's pros, there's cons, pluses, minuses, what have you. What we want you to do is to have this information in hand and in your arsenal. So when you're looking to decide on a trade or decide on a strategy, this might be something for you. You know enough about it to decide whether or not this trade's appropriate for you. So let's go ahead and look at some examples. Again, everything is hypothetical. And here's the situation. We've got stock prices trading for $100. And we look at our option chain, right, because we are neutral to moderately bullish on the security. That's going to be our forecast. Our objective is twofold. We're looking to generate premium income, and ideally, we're looking to buy stock below where it's currently trading. So right now, it's currently trading for $100. Remember, if we liked it at 100, we've got to love it at 95. Well, that's kind of the situation here. We're thinking that maybe the stock is overvalued and there's going to be a pullback coming up, or maybe there's, again, going to be that temporary downturn in price. We would love to own the shares for $95. So we look at our option chain and we see that that $95 put is trading for $3. We go ahead and sell it. So now our break-even point, remember, is going to be our strike price, because that's where we're obligated to buy those shares all the way down to zero. So $9,500 is going to be our risk, of which $300 is already in our account because we sold that put. So we're going to need to deposit the difference, which would be $9,200. So our maximum gain is going to be, if unassigned, if the stock doesn't go below 95, let's say stock stays at 100 through expiration. So it's likely that our short put would be unassigned. We would keep that $300 to ourselves. So that would be the maximum gain, the premium that we collected when we sold that option. That's our maximum gain if unassigned. If we do get assigned, now we become shareholders. And in this case, we're a shareholder. We buy stock for $95 minus the $3 that we already collected. So we're really long the stock from 92, and our potential gains are unlimited, right? If you tuned into any of our previous presentations, we're fond of saying that there is no ceiling, there is no limit as to how high those share prices can go. So if we are now a shareholder, long stock from $92, well, sky's the limit in terms of profit. In terms of our risk, again, we can't lose more than from our break-even point down. So not only is our maximum risk going to be $9,200, because that's going to be our break-even point of 92 times 100, the standard multiplier. So that's going to be our maximum risk. And that's also going to be the capital that our trading firm is going to require for us to have in our account. And again, the reason being is if stock does go to zero, then and we get assigned, our trading firm already has the cash in hand to go ahead and fulfill our assignment obligation. Now, let's see how this looks from a profit and loss standpoint graphically. So had we just purchased those shares outright rather than engage in an options trade, here is our profit and loss, this yellow dotted line. So current share price is 100. You can see as stock goes above $100, we're going to make money. As stock goes below $100, we're going to lose money. But now we throw in the mix of this cash secured put, and here's what this looks like. Here's our $95 strike. Here's our break-even point, 92, because we collected $3 when we sold that option. So here's our obligation to buy shares for 95 minus the $3. Here's our break-even point. So by engaging in this strategy, we lowered our break-even point theoretically from $100 all the way down to 92. So we're going to begin making money on this trade. As long as shares close above $92, we're going to be profitable. If shares finish below 92, we're going to begin losing money. And if we do get assigned, right, now the sky's the limit. Now we're a long stock. So now we're a long stock position going from $92, and there's no limit as to how high those share prices can go. Therefore, there's no limit on our maximum profit. If we are unassigned because the stock finished maybe above our strike price, say, above 95, then our maximum profit that we have is simply going to be that $300. Our contract would likely expire worthless, and unassigned, the $300 that we collected at trade inception, that is going to be ours to keep. Now, I should note that all of these examples, all of these scenarios that we're talking about, not only do they not include trading costs, but more importantly, these are at expiration. So at expiration, if shares don't finish, below $92, we're going to be profitable. If shares, finish somewhere between our break-even point and any point higher than that, we would the contract would likely be unassigned, and that $300, that's going to be our maximum profit. Anything above, we are foregoing. Stock can go to 200. It doesn't matter. We are not going to participate. So that's the explanation or the example that we have when it comes to cash secured put. Let's talk about strike selection, because really this is one of the more important points, I think, simply because of that strike price determines where we buy into that stock upon assignment. And we've got a couple different choices here. Do we want to go in the money, at the money, out of the money? What's the difference? So here's a situation, a scenario. Again, stock's trading $100. We're looking at an option chain about 45 days out. And we can go with a out of the money option, so $95 strike all the way up to in the money at 105. You can see here the differences in the premium. And again, it kind of makes sense, right? If I am obligating myself to buy stock at a price of $95, or let's look at it from the buyer standpoint. Maybe that's even easier to do so. So if I'm buying a put, I've got the right to sell stock, right? I've got the right to sell those shares at my strike price. If stock is trading $100, well, if I've got the right to sell stock at 105, right, above where it's trading now, then that's got to come at a premium. And by premium, I'm not talking about the cost of the option. I'm talking about over and above a normal cost, right? A premium item, a premium, right? The opposite of a discount, a premium. So if I've got the right to sell my shares at $105, $5 above where stock is trading now, it's going to come at a higher premium than if I have the right to sell my stock $5 below where it's trading now, right? If I want to sell my stock $5 below where it's trading, I can maybe collect $3. If I want to sell my stock $5 above where it's trading, and I shouldn't say collect because I'm looking at this from the buyer standpoint, so I would pay $3 to sell my stock at 95 versus paying almost $8 to sell my stock at 105. So the further in the money we go, the more it's going to cost from a seller standpoint, from the cash secured put writer's standpoint. If we sell an option out of the money versus selling an option in the money, if I'm obligating myself to buy shares at 105 when it's currently trading 100 in the market, well, I'm going to want something extra for that because I can just go out in the market now and pay 100 for it. But if I'm willing to pay 105, then I'm going to demand compensation for that, hence the higher premium. If I'm looking to buy stock below where the market is currently trading, well, then it's not going to cost me as much because I'm really getting the benefit by buying shares below where they're trading. So the option premium is going to reflect that versus above where they're trading, and the option premium would reflect that as well. So the difference between in, at, and out of the money from the seller's standpoint of a cash secured put, and out of the money lowers my buy-in price, but it also lowers the premium that I collect, and it also lowers the probability that I'm going to end up a shareholder. So if that is my intent, remember there are generally two objectives when it comes to cash secured puts. Number one is to collect the premium income, and number two is to maybe buy those shares below where they're currently trading. So I may never have the opportunity to buy those shares if the shares don't dip far enough. So out of the money options, I'm going to obligate myself to buy those shares at a lower price if it gets there, but I'm also going to collect less premium to do so and a lower probability of actually being able to own those shares versus in the money, much higher probability of owning those shares, and also a much higher premium that I collect. So let's do a further comparison between these. If I were to sell that $95 strike put, I would collect a $3 premium. My buy-in price, if I get assigned, is $92. This is my break-even point. If I don't get assigned, that $300 is mine to keep versus contrast that with the in-the-money 105. My buy-in price, if I get assigned, is $97.20. But if I don't get assigned, I collect more upfront. So again, it's a trade-off. It's a balance between risk and reward. In this case, selling the in-the-money option, well, sure, I'm going to collect more money upfront and retain that premium if I get unassigned, but I'm also going to be buying those shares at a significantly higher price than if I had sold the out-of-the-money put. So it's a trade-off. Do I want to collect more money upfront and hope that I remain unassigned and retain that cash? Or do I actually want to get assigned because I want to own these shares? And then it's a question of which buy-in price am I comfortable with. So once we decide on our trade, and let's say 45 days goes by and we're approaching expiration, what happens next? If stock prices go down, then it's likely that we are going to get assigned. Again, as I had mentioned, as the option seller, we're obligated to buy those shares. So our account, the cash gets debited from our account. Well, actually, the cash is already in there because it's cash secured. But basically, our trading firm would take that cash that we have in that dedicated account. That would go to the put exerciser, and in turn, we would receive our stock. And now we're long stock, right? So our risk is that of a long stock position, and all of the benefits and risks that go along with that long stock position. If shares happen to climb rather than drop, well, then our contract is simply going to expire worthless. It's likely going to be unexercised. The premium that we collected at trade inception is ours to keep, and maybe we revisit or we look at our plan again. Remember, we were neutral to moderately bullish. Maybe we reassess. Does that still stand? If so, maybe we sell another cash secured put. Are we now more bullish than we were earlier? If that's the case, maybe we just go ahead and buy the stock, or maybe we buy a call option, or some other long option strategy. But the idea is, our contract is likely going to expire unassigned, without value, and now we can reassess. Plus, we've got all of that premium in our pocket from the sale of the option to begin with. If stock doesn't go anywhere, kind of the same. We can reassess what we want to do. If we're bullish, maybe we, do or put on a strategy that is a bullish strategy, again, buying a call, something like that, or we can simply sell another cash secured put. But the point is, we can reassess and we can formulate a new plan and decide where to go from there. Now, my favorite, well, I don't want to say my favorite, but it is my personal opinion that the wheel strategy is a really neat way to continue to churn, and in this case, churn isn't a bad word. We're not talking about brokerage accounts and fees. To churn regular premium income from the two strategies, those being covered calls and cash secured puts. What we're doing is we're alternating strategies. So let's say we start out with a covered call position, right? Covered call position, we're long stock, we're short the call option. If we get assigned on that short call option and we collect our strike price times 100 from that assignment, our stock gets debited out of our account, the cash gets credited in. Now we've got all that cash, and what do we do with it? We no longer have the shares, but if we still like the stock, again, if we're still kind of neutral, moderately bullish, then maybe we go ahead and sell a cash secured put. If that cash secured put gets assigned, we turn around and sell covered calls, because now when that cash secured put gets assigned, now we've got a long stock position. We sell a covered call against it, and we do that again and again and again. The intent here, as you can see, is to generate that consistent flow of premium income. When one gets assigned, then we trade the next one. When that gets assigned, then we trade the first, and so on and so forth. I call it the rinse and repeat strategy. Unfortunately, it never caught on, and my registered trademark was rejected. But the wheel strategy is something a little bit more common that people are familiar with. And let's look at an example of how this works. So again, here's our scenario. We're long 100 shares of stock. We sell that covered call in the hopes of generating that income. And here's our position. 100 shares of stock from 75, we're long. We sell an $80 call against it, $2.50. 45 days later, the position expires. Shares close at 81. We get assigned on our short calls. Remember, that option is now in the money. We're obligated to sell those shares at $80. So we collect our strike price times 100, which is 8,000, and we deliver our stock. We also collected that $2.50. at time of trade inception. So now the closing position value that we've got is $82.50. So that comes out to a $750 profit with this covered call strategy. So now we've got $8,250 to invest. What do we do with it? We're no longer long stock, but maybe we would like to be, right? Remember, we're still kind of moderately bullish on those shares. So we decide to sell a cash secured put. We look at that 80 strike put, it's trading 375. We deposit 76.25, which is going to be our strike price minus the premium we collected, because that's going to be our risk. That's our break-even point. If we get assigned and we were forced to buy those shares at $80 and stock went down to zero, that is our risk, the 76.25. So now we had the covered call position. We got assigned. We sold our shares. With that cash, we sold a cash secured put. Here we are another 45 days later. Stock doesn't really move that much. It's trading 79. We get assigned. We're obligated to buy those shares back for $8,000. And now we're back to our original long stock position. We've got all of that downside risk as a shareholder. But the idea is that now we turn around and we sell another covered call. If that gets assigned, we sell another cash secured put. So that's how the wheel strategy works. It's not necessarily a hybrid of the two strategies or a combination of the two, but it's basically trading one and then the other and then the one and then the other and so on and so forth. Something very, very popular and something that I hope if you decide to trade, I hope it's something that works out well for you. So let's go ahead and look at the key takeaways that we hopefully learned from today. Cash secured put, it's a two-part strategy involving the short put and the cash to cover that assignment. In terms of a forecast and objective for the cash secured put seller, they're generally neutral to moderately bullish. In terms of an objective, they're looking to generate premium income, or they're looking to get into the stock at a discounted price. Remember, if you like it for 100, you've got to love it for 95. One of the phrases I'm very, very fond of from the trading floor. The strategy involves a short put, which means that we must be prepared to buy shares. We must be prepared to receive that assignment notice and fulfill our obligation, regardless of how shares might go. We don't have a choice. When we get assigned, we must fulfill that assignment obligation. And I want to pause here for a second because this brings up a question that we received, that we often receive at the investor education desk, and one that we received not too long ago. An investor had written into us that they were unexpectedly assigned on a short option, I believe it was a short put. But the point is they were unexpectedly assigned. Their contract expired at the close of business. They had a spread on. Their both legs expired out of the money, and they took no action. Well, after the close, there was some news of this company that caused share prices to significantly increase, the spike after the close. And they ended up getting assigned on their short put because the long put holder proactively contacted his or her trading firm and did what they call a contra or contrary exercise, where they are explicitly giving directions to their trading firm to exercise an out-of-the-money contract. That, in turn, led to the assignment for this individual. And the reason I bring this up is because they, in turn, mentioned that, well, since they got unexpectedly assigned, why didn't they have the opportunity to then, in turn, exercise their long contract? And sadly, I had to go back to them to tell them that once you receive that assignment notice, you have no choice but to fulfill that obligation. Assignments are the last part of the option trading process. So after the close of business and open interest gets all tallied up, long positions, short positions, et cetera, then the exercise process begins, where long contracts will get exercised automatically, or I should say long in the money contracts will get exercised automatically. But the option holder, whether it's a call or put, also has the right to still exercise that contract even if it's out of the money. Once those exercise notices are processed, then assignment notices go out, and that's the last step. So there is no opportunity for a short put writer or a short call writer. There is no opportunity for them to manage that position, which is one of the reasons why many investors with short positions will close out that position just prior to expiration, prior to that close of business. Even though it's out of the money, they go ahead and buy back that call to close. They buy back that short put to close. So this way, no matter what happens, they no longer have a short position, and they no longer are obliged or obligated to fulfill the terms of that contract, because that contract is closed and now they no longer have that in their position. So just something I wanted to bring up, because it is a question that we do get asked time and time again. Back to the presentation, though. Upon assignment, now you're long stock, and all of the risk that goes along with being long stock. Again, remember, share prices theoretically can plummet to near zero, and if you're buying those shares at $95 and they trade down to zero, that's going to be a stock position that is going to leave you rather unhappy, I would guess. So all of that risk still being long stock. And however, the flip side to it, not necessarily if the shares go to zero, but something that people do, if you do get assigned, then they do what we call the wheel strategy that we just talked about. You get assigned on that short put, you sell a covered call. You get assigned on that covered call, you go ahead and sell a short put. So that's the wheel strategy. That's what I have for you today. I certainly hope you enjoyed the presentation. We're going to be getting to Q&A in just a moment, but before I do, just to give you some more information about OIC. Again, we do most of our content offerings on our website, optionseducation.org, where we've got OCC Learning. That's going to be your e-learning destination. We do have a 9-course curriculum called OIC Academy that we're packaging up right now and putting the bow on. So that's going to be coming out shortly. If you've already been taking these OCC Learning courses, you're already familiar with them. This is not a new product. It's just a new package where we're going to be putting all the curriculum into one single product. We also have our podcast and videos on our website, and then live chat with myself and my colleagues, Ken, Matt, and Roma. Optionseducation.org is the website. Investor Education, our email address, options@theocc.com. And please feel free to follow us on YouTube, other social media, Facebook, Twitter, or X, as they call it now, etc. You can find us out there to keep abreast of our upcoming presentations and other offerings that we have. So let's go ahead and end this slideshow, and let's get to some questions that came in. Let's see. Time frame. When you sell a covered call, do you typically go 45 days? Also, strike price, do you look at deltas? What number? Look at charts for resistance, etc. It's a good question. And unfortunately, I don't have a concrete answer. And the reason being is because I may have a strategy that works for me. I may have a time frame. I may say, I look to sell options 30 days out, or I look to, trade a particular security, or I look for high deltas, or I look for low deltas, what have you. The point being is that what works for me may not work for you. And because of that, it's really hard for us to, give a rule of thumb. It's hard for us to say, well, you should look to sell, maybe low delta puts because that's a low likelihood of assignment and therefore a higher probability that you keep all of the premium that you collected at trade inception. Or, somebody else can say, well, no, not me. I look for high delta puts because I want to get assigned. I want to, become a stockholder. I want to be able to buy that dip. If I get assigned on my short put, that means that the stock pulled back to where I was expecting it to or where I was wanting it to, and now I'm a shareholder at the price that I wanted to be a shareholder. The point being is that there is no best way. There is no, one-size-fits-all or rule of thumb. Everything is going to depend on the individual investor. What's your risk tolerance? How much cash do you have in the account, right? Obviously, that's, if it's a cash secured put and you need to pony up the appropriate amount of money to, cover assignment, are you going to be doing that on a stock with $500 strike prices, or are you going to do it on a stock with, maybe $50 strike prices? So all of that is going to depend on the individual. So we can't really, give you a one-size-fits-all on that. Let's see what else we have. Well, this pertains to that little sidebar that I took a moment ago. How long after the market closed can you get assigned? It's kind of a loaded question. Technically, all contracts expire at 11:59 p.m. Eastern time. So what that means is you cannot get assigned. Well, let me back up. So that means there are no exercises that occur after the day of expiration. So if we've got talking about a monthly contract or even a weekly contract that expires on a Friday, 11:59 p.m., that contract no longer exists. Now, that being said, you may not receive your assignment notice until Saturday or Sunday or Monday or Tuesday or what have you. Believe it or not, there is no rule that dictates how or a time frame in which you must receive this assignment notice. What you'll want to do is you'll want to have a conversation with your trading or brokerage firm. Ask them about their policies. Typically how do they notify their clients or their customers of assignment? And when do those notices typically come in? Also in that discussion, you're going to want to talk about the flip side of the assignment process, which is exercise. And the reason being is because different trading firms have different deadlines for when those exercise notices must be received. Now, if your contract is in the money, it's typically going to exercise automatically, and so there's nothing you, as the investor, needs to do. But if you're looking to do what we call a contra or contrary exercise, in the example I had said, the contracts expired out of the money, but there was a run-up in share price after market close, and the investor that held the long option chose to exercise that contract by giving explicit instructions to their trading or brokerage firm. Now, the deadline for those instructions, the cutoff time for those instructions, is going to vary from firm to firm. So again, this is going to be part of the conversation that you want to have with your trading firm. When is that cutoff window? How do you submit a contrary notice? Maybe you don't want to exercise an in-the-money contract because maybe the share prices are falling in the after hours. So even though your call option expired in the money, you don't want to buy stock at 50 when it's trading 45 in the aftermarket. So find out from your trading firm as to both assignment and exercise policies to find out about that cutoff time. Here's a question that just came in: an IPO, a recent IPO, is it okay to do options on a company that's only been traded for a little bit? Again, yes, it's okay to trade options on a company that's been around for a short period, and no, it's not okay to trade options on a company that's been around for a short period. The point being is we're not advisors. We don't make recommendations. I don't know if it's okay to trade on that or not. I'm not familiar with these companies. All of these decisions should be your own. You, the investor, you need to make these decisions as to whether or not it's right for you. You can also contact your brokerage firm and talk to your broker. Hopefully, they can give you some advice. The only thing that I would say in this instance is that, one of the things about longer established companies is you've got a track record. You have some expectations of how they performed in the past, and those expectations may influence your view of how this company may perform in the future. If there's not that time history, if you don't have that record of how things have been because it's only been around for a month or two, that's not to say that investing in that company is a bad idea. It may actually, because investors may see it as a more risky proposition, you might get a better option premium as a seller. There's more risk, so therefore you're going to be demanding a higher premium when it comes to selling options. That may or may not be the case. But whether or not it's a good idea to invest in any particular security, unfortunately, that's just something that we don't get ourselves involved with. Are you part of that? Is not us. Not sure why that question's there. Let's see what else we have. How about how many days ahead of expiration can we get assigned early? Does that vary by broker to broker? And the answer is no. You can get assigned the very day that you sell an option. So I sell an option today, I can get assigned today. It doesn't vary by broker to broker. The reason being the assignment process is random. So OCC, the company that Ken, Matt, Roma, and I all work for, OCC receives these exercise notices from all of our OCC clearing firms. We then take those notices and randomly assign them to another clearing firm that has customers with a short position in this particular security and this particular strike and this particular expiration date. Now, that clearing firm then doles out those assignment notices by some process specific to that clearing firm, whether it's random, as OCC does, or some other situation, first in, first out, or, something of that nature. But again, that's a process that you would, and then your trading firm gets that assignment notice, and then they assign that assignment notice to one of their customers. So the process goes, OCC receives the exercise notices. Then on the flip side, we randomly assign those notices to our clearing firm. Those clearing firms then assign those notices through some process to their brokerage firms and trading firms, and then those brokerage and trading firms then assign those exercise or assignment notices to their customers. So again, it's a conversation that you're going to want to have with your trading firm as to how things get processed. Does the broker freeze the cash until the trade closes out? So I would expect the answer to that question is yes, because that cash is pledged to fulfill the obligation should you get assigned. It's my expectation that the cash that you use in the cash secured put cannot be used for any other reason. It's not going to be part of your buying power. If you're looking to trade more options, my expectation is that that cash is held and cannot be touched until you either close out the trade through a buy to close transaction, or the trade gets assigned, or it simply expires without value. And it looks like we've got one more. So let's go ahead and let's see. Let's find one more question. And I apologize here. I had one, and now I don't see where it went. what is the best way to determine that short put strike? Do you use a support? Do you use the delta, et cetera? Again, unfortunately, this falls into the realm of recommendations and advice. What I can tell you is that short put strike is going to be the price that you need to be comfortable buying that stock. So, you remember, or if you remember something, a joke at a car dealership, the salesman would come up and say, what do I got to do to put you in this car? It's kind of the same thing with the strike price. What is it going to take for you to want to buy this stock? If stock's trading $100, and if you're unwilling to simply just go out and buy the shares at 100, are you willing to buy it for 98? Are you willing to buy it for 95? What is it going to take to get you into the stock? So that's, kind of the first step is what strike price, what dollar amount am I comfortable with owning these shares? The second issue is the premium that goes along with that strike price. If stock's trading 100, well, sure, I'd love to own it for 75, but a $75 strike might only have a corresponding premium of, a nickel, if that. So sure, I'd love to buy the stock for $75, but I'm not going to generate any premium for that. So if I don't get assigned, if shares don't drop to 75 or below, and I don't get assigned, and now I'm not a shareholder, well, I'm not generating any income out of that. A nickel isn't really generally considered premium income. So, what price do I want to get into the shares? It's going to be a trade-off with the premium that I can collect from selling my option. But it's also, what's the probability of assignment? Again, stock's trading $100. It's much more probable that shares will be trading $98 than it would for shares to be trading 95. So if I'm looking at two different strikes, and remember, I want to be a shareholder, right? If I'm selling a cash secure put, I'm accepting the reality that I might be a shareholder at some point. So if that's going to be the case, what is the probability of that reality coming true? And if I'm moderately bullish on the stock, or maybe, again, remember, I'm temporarily bearish, but I'm expecting shares to rebound, and then now I'm bullish, the reality or the likelihood of me becoming a shareholder at 98 is much greater than me becoming a shareholder at 95. And then it's also, what happens if shares don't get down to 95? Let's say they dip down to 98 and then they go up to 105. If I had that $95 strike, well, not only did I not become a shareholder, but now I missed that, that rally in the stock, which I was expecting to happen anyways, and now I missed out. So just like anything else, there's going to be a trade-off when it comes to strike price in terms of premium that you collect, obligation that you have, probability of that obligation, coming to fruition, et cetera. Everything's going to be a dance. Everything's going to be a balance, a trade-off, risk versus reward, probability versus reality, et cetera. So that's going to be the trade-off. And again, unfortunately, I see a lot of these questions that are here, about which technical analysis, items should I be looking at, what delta should I be trading, et cetera. Unfortunately, these are all recommendations and advice that we are prohibited from addressing. So, please accept my apologies. That being said, if you did ask a question that either didn't get answered by Matt and Ken, who are behind the scenes, again, gentlemen, thank you so much. Or if it didn't get addressed during our Q&A portion at the end, please keep an eye on your inbox. We will be responding to these questions tomorrow. Also, as soon as we end this session, there will be a survey that pops up on your screen, so please take a moment and fill that out. Let us know what you thought of the topic. Let us know what you thought of me as a speaker. And I really hope that you got a lot out of this love, talking options as do my colleagues. So this is something that we really enjoy doing, putting on these presentations to investors and viewers like you. So really, thank you for your time. Thank you for joining us today, and we'll be talking with you again very soon. Take care, everyone.